All right, so I'll just give a quick preview of who's up next. So in this next talk, which is we're going to be joined by two people, Jeffrey Troy and Dhruv Dang. They're the two co-founders of Qoda Protocol. Qoda Protocol is a DeFi lending and borrowing protocol built on Moonbeam with several key features that I will just give a preview of. So that includes an on-chain order book for lending and borrowing, isolated collateral, and hybrid over-collateralized and under-collateralized borrowing. Now, traditional borrowing and traditional money market protocols have a number of issues regarding global collateral, price discovery, and over-collateralization. So in this talk, Jeffrey and Dhruv are going to cover all of those and discuss how Qoda Protocol addresses those. So with that, I'll hand it over to you guys.
Thanks. Hey guys, I'm Gio. I'm joined here with our co-founder Dhruv. Just a quick note before we start. This talk is more geared towards end users of DeFi rather than a dev-based kind of tech talk like the schedule suggests. So just a heads up. So before digging deeper into the details, I want to first introduce everyone to our team. Okay, so Dhruv and I both met about 10 years ago, working together as fresh grads on the trading floor at Deutsche Bank. Dhruv pretty quickly moved on to bigger and better things. I'll let him speak for himself. But as for myself, I came from a pretty heavy TradFi background. I was a high-frequency trader at Deutsche on their fixed income and currencies desk, market making FX derivatives. So I joined Coda because I wanted to apply the knowledge and skills that I've built up in the traditional finance world to help with growing the DeFi market. I'll pass on to Dhruv to speak a little bit more about himself.
Thanks, Gio. After working together at Deutsche, I spent time with Apple's instructional products team, Change.org's revenue engineering team, and founded a software consultancy that serves the government of British Columbia. I'm excited to use my product development experience to make efficient loan markets more accessible for everyone with DeFi. Back to you, Gio.
So together with our amazing team at Enso Labs, which is the company behind Coda, we are helping to build a completely novel, completely unique protocol from scratch, from the ground up, no forking of any other project's code base, using the technical skills and the domain knowledge that we've built up over the years to tackle the DeFi fixed income space with Coda. So let's start first with a recap of what we are dubbing money market V1 protocols. So these are your compounds, your Aves, your old school kind of traditional lending borrowing protocols seen on DeFi. So these protocols are pioneers because they have laid the groundwork for one of the most critical infrastructure in DeFi, and that's connecting users who have excess capital to those who need it. That being said, though, these money market V1 protocols do have their own limitations. So particularly, we've highlighted 3 key flaws with money market V1 protocols that we hope to solve with Coda. The first of these is what is called the global collateral problem. So the money market V1 protocols use this global collateral system. And the reason why they do this is because for Compound and Aave, they have a limited number of assets that you can borrow, a limited number of assets that you can lend in. And the reason why they do that is that every new asset that's enabled in the protocol is also automatically usable as collateral for borrows. The problem for this is that when these assets have low liquidity or extreme price volatility, the value of the collateral that's being posted can also fluctuate very wildly. So this limits the number of markets that the protocol can support, since any single asset that's supported could potentially pose a systemic risk to the entire system. So for lower risk, highly liquid blue chip assets, they can pretty easily be enabled on money market V1 protocols. But for riskier, longer tail assets, these protocols can't ever really be able to support these types of assets. The second issue for money market V1 protocols is the price discovery problem. So these protocols determine interest rates based on the utilization ratio, which is the ratio of how much has been borrowed to how much has been lent in any particular market. So, for example, let's say in the WBTC market, there's 1,000 BTC being supplied and 600 BTC being borrowed. That gives a utilization ratio of 60%. And if there's 1,000 BTC being supplied, 800 being borrowed, then that's a utilization ratio of 80%. The higher the utilization ratio, the higher the interest rate. And that makes sense because a higher utilization ratio means higher demand from users to borrow BTC. The problem, though, is that whoever set this the interest rate curve parameter at the start has to predict the market dynamics correctly for every single market. Otherwise, if they set interest rates too high, they won't be able to attract borrowers, or even worse, if they set the slope of interest rates too low for higher utilization rates, they'll be overutilized. That means that even at 100% utilization ratio, interest rates aren't high enough to attract new lenders, and that causes existing lenders to not be able to withdraw the tokens. So ultimately, real-life interest rate markets are dictated by supply and demand with very complex, non-linear price dynamics, and they can't just be predetermined by the dev team. The final problem is the over-collateralization problem. So money market V1 protocols only support over-collateralized borrowing. So if you supplied $100 of collateral, you might only be able to borrow up to $60. So this is generally a necessity in trustless DeFi protocols, but this type of over-collateralized borrowing kind of limits the types of use cases that a borrower might have to want to borrow. In practice, the main fundamental demand for over-collateralized borrowing generally comes from retail users who are supplying crypto assets, borrowing dollars, and using those dollars to buy more crypto assets, essentially for creating leverage long positions. And that works fine in a bull market like 2020, 2021, when everybody wants more and more long crypto exposure. But that type of demand quickly dries up during sideways or bear markets because the demand for leverage long positions isn't there anymore, right? In contrast, under-collateralized borrowing generally has more predictable, more evenly distributed demand for borrowing, and that's uncorrelated to whether we're in a bull or bear market. So let's move on and discuss some of the properties that make the Qoda protocol unique. So to address the over-collateralization problem, we have built Coda from the start to support a hybrid model where anonymous, unpermissioned users still have to put up more than 100% collateral to borrow, just like in Compound. But we also allow for the protocol to issue credit facilities to permissioned KYC'd institutional borrowers. And because these institutions are doxed and KYC'd, they are incentivized both legally and reputationally to repay their loans. Generally, these types of institutional borrowers are comprised of crypto hedge funds that borrow stablecoin to fund their so-called delta neutral arbitrage strategies. That means that the fundamental demand for borrowing remains high in bull, bear, or crab markets. Next, Coda uses an on-chain order book model, which highly mimics the way that centralized exchanges do crypto trading. So just like an order book for buying and selling tokens, we can create an order book for loans, where buyers are borrowers on one side and sellers are lenders on the other side. And the price is the prevailing interest rate. So users can either create what we're calling quotes, which are essentially limit orders to borrow or lend tokens at a user-specified APR, or they can execute against an existing quote in the order book with the terms that suit their needs. Order books inherently capture the nonlinear nature of supply and demand and its relationship to price dynamics. When we allow for the market forces to freely dictate the prevailing interest rates, we can solve that price discovery problem that we were mentioning that plagued the money market V1 protocols. And because of the way that Coda's order book is implemented, it also gives us the next feature for free, which is the segregated asset tiers to solve the global collateral problem. So with the Qoda protocol, there are two distinct types of assets. We have collateral tier assets and market tier assets. So collateral tier assets are highly liquid blue chips like stablecoin USDC or wrapped Bitcoin or wrapped Ethereum. And these are explicitly enabled to be used as collateral. And these collateral tier assets are completely isolated from market tier assets. Market tier assets being the markets that you can lend and borrow in. So this means that Coda can potentially spin up lending borrowing markets rather, even for more illiquid, riskier assets without creating a systemic risk to the protocol. Another cool feature of the on-chain order book model is that it lets users participate in fixed interest rate loans. So this is in contrast to money market V1 protocols, which have kind of floating interest rates that fluctuate on a daily basis. Generally, fixed interest rates are superior because it means lower volatility for lenders and borrowers. One thing that I want to mention, though, is that just because Coda loans are fixed maturity loans, doesn't mean that users are locked in for the full duration. So just because you have a loan for 1 year doesn't necessarily mean you have to hold it all the way for the entire year. Because the order book treats borrowing and lending like buying and selling, if you have lent into a market, you can always exit early by borrowing back the equivalent amount or vice versa. So essentially, you can exit early out of a loan anytime by reversing the loan. The last cool feature at Coda has to do with transparency. So one of the big lessons that we learned from centralized platforms, for example, with Celsius and more recently with FTX, is that users suffer when there is a lack of transparency in the platform. And that is transparency in all aspects. So that's transparency on size of the loans, transparency on the total amount of loans on the books, transparency on whether the loans are being repaid, all of that. So, what happens when there's rumors of trouble in a non-transparent, in an opaque lending platform like Celsius, is that it triggers a bank run. So this is where all the lenders are trying to redeem all at the same time because they are worried about losing the money, right? The result is that the first few lucky lenders end up getting back 100% of their funds, while the late redeemers usually end up losing everything. So to promote transparency at Coda, we have a concept of a repayment redemption ratio, or RRR for short, which is the real-time ratio of the total amount that borrowers have repaid divided by the total amount that lenders are owed. So in the unfortunate event of a borrower default, any potential losses due to bad loans are socialized equally to every single lender based on this RRR to ensure fairness to all users. So I'll give an example. Let's say the USDC September 2022 market has just expired. And let's say in total, lenders are owed 1 million USDC, while borrowers have repaid only 600,000. So that gives us bad debt of 400K and a repayment ratio, a RRR of 60%. And based on that RRR of 60%, every lender in the market shares that loss from the bad debt equally. So each lender can only redeem 60 cents for every dollar they've lent. So, while it's unfortunate that, there are cases that bad loans happen at sometimes, this is at least a fairer system that socializes losses instead of incentivizing lenders to kind of scramble to be the first one to redeem, like on centralized lending platforms. Lastly, if bad debt later does get repaid or if defaulting borrowers are liquidated, lenders can still continue to claim equally the share of the debt that they're owed slowly over time. So we've been talking a lot about theory. I will pass it on now to Drew to go over a quick demo of how Coda works.
Thanks, Gio. Let's take a look at the Coda dApp. So this is currently live on testnet. So we'll connect to the dApp using MetaMask on the Moonbase Alpha network. Great. Let's look at the US dollar coin November 22 market, which expires at the end of this month. On the market page, we can view the top quotes in the order book. Quotes are like limit orders for loans. We can also see recent trades that were executed by counterparties in the market. We want to borrow some USDC. Since we're an anonymous user without a credit facility, we must first deposit collateral before borrowing assets. So we're visiting the collateral page to deposit 0.1 BTC as collateral. Awesome. Now that we've deposited some collateral, we're ready to borrow using Coda. Let's head back to the USDC November 22 market. So we want to borrow funds on our own terms. So we're going to publish a new quote. This is the new quote form. Today, we're willing to borrow up to 100 USDC at an APR of 2%. After reviewing our quote's terms, we must sign and publish our quote on MetaMask. Nice, our quote is live. We can see all of our open quotes on our portfolio page, including this recent quote to borrow up to 100 USDC at an APR of 2%. All right, by returning to the USDC November 22 market, we can also see our quote live in the order book. Let's now try lending in this market. Instead of publishing a new quote, let's accept an existing quote from the order book. On the accept quote page, we can review the quote's details and enter how much we want to lend. If we choose to lend 30 USDC at this quote's APR of 4%, the DApp will automatically estimate how much we will be repaid after the market matures. In this case, we'll earn approximately 10 cents of interest from our 30 USDC loan. This looks good, so let's go ahead and execute this trade. Great. Accepting this quote instantly transfers 30 USDC out of our wallet to the borrower and credits us with 30.1 USDC NOV22 Q tokens. These Q tokens track how much interest and principal we are owed in the market and can be redeemed 1-for-1 for their underlying USDC after the market matures. By importing this market's Q token into MetaMask, we can see our 30.1 QUSDC NOV22 balance. And there it is. Revisiting the portfolio page shows us our open lend position. Once the market has matured, we can redeem our principal and interest from this page. And that wraps up this whirlwind tour of Coda. We're currently live on the Moonbase Alpha testnet and are planning to launch on Moonriver by January 2023. There is also an opportunity for folks to earn some rewards by testing out the DApp on testnet. We'd love for you to be a part of the Coda community, so join our Twitter and Discord to get involved.